Uh, am I audible?
Yes, sir.
This is the second paper, that capital investment and financial decision. In this paper, it is divided in 5 blocks, and we have to cover 15 units. In this, I will start with topic wise. That mostly what are the questions, and I have taken the topic that which are the important topics, and what we are going to cover. This is project life cycle. That here the question is discuss that distributed future of the project. I explain the concept of project life cycle, and discuss the unique characteristic at each stage of project life cycle. And the second question was explain and the nature of project, and discuss the project life cycle. Uh, what actually project life cycle is? Let us define the phase that connect. You can say in the beginning of project its uh, to its end. So whatever the project from starting to end. Let me give you one example, that when an organization identifies an opportunity to which it would like to respond, it will often I will say authorize a feasibility study to decide whether it should undertake the project. That project life cycle definition can help the manager to clarify whether to treat the feasibility study of the first project phase, or as a separate standalone project, you can say, where the outcome of such preliminary effort is not clearly identifiable. And it is best to treat such effort as a separate project. The phase of a project life cycle are not same as, you can say, project management process. Sorry, this election has came. Sorry, sorry. Okay, now let me start again. Let me tell you that where I have left, that the phases of this project life cycle are not the same as the project management process group. And this the transition of one phase to another within the project life cycle generally involves and is usually defined by some of from the technical transfer, you can say, or handoff. And it will be deliverable from one phase, are usually reviewed on the completeness, you can say, accuracy, and approved before work starts to the next phase. However, it is common for the phase to begin prior to approval of the previous phase deliverable. And when this risk involved around the deemed acceptable position, this practice of overlapping phase normally done in the sequence, and it is an example of this application of schedule, you can say, compression technique, or you can say also called that fast tracking. There is no single best way to define this ideal project life cycle. Or some different organizations have different policies. They establish different policies. They that standardize that all the project with a single life cycle, while others allows the project management team to choose the most appropriate life cycle, or you can say team project. Further, industry common practice will often lead to use the preferred life cycle within the industry. Uh, Project life cycles are generally defined, or if I say, the basic question will arise that what technical work do in each phase. For example, in which phase would the architect work is performed. Second, the question will arise that when these deliverables are generated in each phase, and how each deliverable is reviewed, verified, or validated, you can say. The third will come, the third question will come automatically, that who is involved in each phase. For example, concurrent engineering requires that the implementers to be involved with requirement and design. And lastly, it will come that how to control, approve each phase. This project life cycle descriptions can be, you can say, very general or very detailed. And highly detailed descriptions of life cycle can include forms, charts, and you can say checklists to provide uh, structure and control. And the project life cycle shares a number of common characteristics. That is, the common characteristics are, you can say, phases are generally subsequential or usually defined by some form of technical information transfer or technical component hands off. Cost and staffing levels are low at the start and peak, you can say, during the intermediate phase, and drop rapidly as a project draws to the conclusion. You can say to the end, and the level of uncertainty is the highest. You can say risk of failing to achieve the objective will be the greatest, in the highest, or you can say uh, like it is greatest to start the project the certainty of completion generally gets progressively better as the project continues. And last, the thought will come that ability of stakeholders to influence the final characteristic of the product, you can say product, and the final cost of the project is the highest at the start and gets progressively lower as the project continues. And a major contributor to this phenomenon, you can say, is the cost of changes and correcting errors generally increase in project continuity. Although you'll find that many project cycle have similar phase, name with similar deliverables, you can say few life cycles are identical. Some can have four or five phase, but others may have nine or more. Single applications area are known to have, you can say, significant variation. And one of the organization software development life cycle, this is the example I'm giving you, that one of the software development life cycle can have a single design phase, which another can have separate phase for development and detail design. It cannot be same. And so there could be sub projects that can have distance different project life cycle. uh, the what is happening that here logical sequence of activities are there to accomplish. You'll find this project goals to and achieve, means to attend that objective. The project is initiated to achieve in a, you can say, basic mission, and it have to set to be completed when the mission is achieved. Let me make you more simple. Uh, the entire duration which starts the project completion and ends the project closure, it is called life cycle. And what question, again, what type of questions comes, what technical work to do in each phase, and who is involved in each phase, and who will monitor, who will do the work, and who will take up the initiative, what type of resources are required in each phase for that project, How and when deliverable generated in each phase be reviewed, verified, and validated. How to control and approve the phase. This path of a project takes the from the beginning to the end, and generally referred it is referred as phases of project life cycle. And sometimes these phases may overlap to each other, but the entire time frame, or you can say project life cycle of project may or method of dividing the phase in the project may differ somewhat from industry to industry, and from product to product. But in general, most life cycles uh, are the same. First initiation phase is there, that in this phase it involves the identification of needs, idea, problem, and opportunity. The idea may be first come to the mind when one is seriously trying to overcome certain problems. The problems may be non-utilized of either availability of fund, plant, capacity, extra. Many projects are facing difficulties, you can say, in this phase, because the concept is too seated or cut off before it is finished. And this tension is prematurely turned down, and a means of accomplishment of this, you can say, objective. Therefore, the project objective needs to be fully explored and developed in the conceptual phase. The major objective of this mission is are determine the existing needs, or you can say potential requirement of the current project. And second major activity will be that provide initial answers to the questions on cost, availability of performance level, you can say, and its compatibility to the other project or other program. Thirdly, I will say that identify all resource essential for the effective management, and fourthly, it will be determine the initial project interface, and design an appropriate organizational structure for the project. And the whole working of this phase can be structured as follows: that is, prepare business case or plan. What is this actually? It is a it is a written document to describe all internal external elements involved in new project. The business plan must describe the current status, that expected to needs, that and you projected results of the new project. Secondly, you have to do the you have to perform feasibility study at any stage during or after the development of the business case. A formal feasibility study may be commissioned. It is analyze the viability, or you can say justification of an idea through a disciplined and documented process of thinking through the ideas from its logical beginning to its logical end. Appointment of a project team and setting up a project office is required, because it recommended solution is approved. If the project is initiated to deliver the approved solution, that major deliver and participating work group are identified, and the project teams and its office begin to take office, take shape, you can say. And these participants involved in preparing the business needs document and developing the project proposal include the sponsor or entrepreneurs, you can say business process owners, business analysts, project managers, and technical. Second phase is defining phase. In this phase, you will find that solution to the business opportunity are evaluated, and preferred approach is defined. And this phase include the initial preparation of all documentation necessary to support, you can say, projects such as policy, procedure, job description, budget, and funding your papers, letters, and many things. And the definition phase represents to beginning you to end thinking. I'll say through the project, but they does not accomplish the project in for of itself. And the project definition procedure is plainly written and description of this project in sufficient detail to support, you can say, a proposal request of a customer undertake. Uh, what all activities are there in this definition phase, that preparing a detailed preparing the detailed plan required to support the project, estimating the realistic costs, spotting the area, defining interfacing of the project, ascertaining the others necessary sub systems and project. And ultimately what happened, that a project charter is prepared, and with which you will find that outline of mission, objectives, scopes, uh, deliverables, and structure of the project is there. That is well defined objectives and policy serves as a, you can say, framework of the decisions to be made throughout the life of the project. That project manager has to seek a compromise between the conflicting goals and technical performance, and that cost standard, you can say, time target is there. Then next phase will come, that planning and growth phase. In planning phase, the detailed plans are prepared and tasks are identified with the appropriate milestone. Budget is there and resources are there. And planning consists of refining all the works required to be carried out, so that all the project participants will understand their role in the project team and carry out what is called work assigned to them. And some organizations, however, prepare documents such as project execution plan to mark this phase. Organizing, you can say, is the process of defining and analyzing these activities of the enterprises. You can say uh, grouping the activities uh, into distant areas and department of, you can say, establishing the authority responsibility relationship among them. It is it also involve, I say, organizing the resource required for the accomplishment of the organizational objective. And in a project environment, organizing you consist of, you can say, the different sub process. Here again, the same thing will come up, that defining the scope of the project, terms of product service to be delivered by the project, forecasting and estimating, you can say, the of resource, that is man, material, machine, money, and that is required for the project, arriving to an appropriate organizing structure, identification and management of resource in order to facilitate, you can say, the production process, such as inventory, supplies, labor fund, preparing detailed cost estimates for all activities, determines the required resource of all activities. What, you can say, what we have to prepare with all these, we have to prepare a project plan, that or a schedule. That project plan is created outlining the activities, tasks, dependencies, and time frame. And this production and operational plan, that this plan includes strategies, you can say, related to suitable location, physical layout of plant, availability of the cost of raw materials, machinery, equipment, cost of manufacturing, and operations. Uh, then resource plan has to be made, then financial plan has to be made. Like this.
we will go into the next phase, that is implementing phase. That project implementation is the key phase of this project life cycle, during which this project plan comes to life. This phase involves the execution of each activities and task listed the project plan, listed in the this that project plan which we were discussing previously. And it is important to maintain the control, you can say, and communicate as needed during implementation. As the executing phase progresses, groups across the organizationally it becomes more deeply involved in planning, you can say, for the final testing, production, and support. But you can say it should proceed with different ways depending on the required project outcome, as well as the schedule, staffing, and you can say cost control. Project management at the here it's also have the some activities that is keeping the people informed about the progress of the project, project priorities to be understood. It should be translated its activities in work in progress, and this monitoring the environment, anticipating problem, and taking the actions to counter any issue. And review then after that, reviewing the change of or a change request, you can say, that project teams, and recommending whether they will be done within the project or not. Evaluation of technical, social, and economic sufficiency of the project will be there. Last is phase is there, that is terminate project. Sometime in few you'll find one more closer. But terminate is the last phase, that this is the final phase of the project work, and that commencement of the project closer phase is determined by this completion of all the project's objective, you can say, acceptance of the end of the product by the you can say management. The you can say project process in is completed document and finished product is transferred to take care and control over the owner. And the long term objective is to build a project management repository in document best practice and lessons learned, you can say, during the project. And the lessons learned from an integral part, you can say, of the project closer. Uh, it is a closer phase. Uh, that what I will say that there is productivity improvement of this project team, or help in identifying to do and do not of the project. And this there are activities in this project is that demonstrate that project is complete. Arrangement of relevant to project files are proper. uh, Access, you can say, access to success of the project is there. Ensuring the project accounts is there, supporting departing of the staff is there. What for after shutting down that some cleanup performances there, like the performance review, that last steps of this review, to conduct the lessons learned, studies to examine what went well and what did not. Success is determined by how well is performed against the defined objective of the performance. And the second point is post completion audit, that is required, that an audit of the project after its commission it is done, which is referred to as post audit and post completion audit. What is the characteristic of because after when you understood this phase, different phase, then you can write yourself characteristic of this project life cycle. It will be, yeah, if I'll say, it will be subsequential in nature. Costing and staffing will be low. The influence of stakeholders will be there, and level of uncertainty and its risk will be low. Risk will be low. That is what it is. It comes out if you have understood that phases. If you have not understood that phases, then you will not able to write these characteristics. Uh, we have so for completed phases, we have completed characteristic. Now, that advantages of using this product life cycle. Uh, the product life cycle can better allows the marketers and business developers to better understand how each product or brand sits with the company's portfolio, and this enables this company to internally shifted resource to specific product based on those product position within the product life cycle. Let me give you the example that a company may decide to relocate market staff time to product entering entering the introduction, or you can say growth stage. Alternatively, it may need to invest more cost of labor in you can say engineers and customer service, or you can say technician, as a product matures. The product cycle naturally tends to have a positive impact on economic growth, as it promotes innovation and discourage supporting outdated products. As product moves through the life cycle stage, companies that uses the product life cycle can realize and needs to make their product more effective, safer, efficient, faster, cheaper, and you can say better suited in the clients. Limited of using this product life cycle, despite its utility, the planning and analysis, you will find that the product life cycle does not, uh, you can say, pretend to every industry, and does not work constantly across all products. And considering this popular beverage line, whose primary products have been in the maturity stage of decades, while spin-off or variations of these drinks from the same company have failed. The product life cycle may be artificial, you can say, in industry with legal trademark restriction. Considers considers the new patent term of 20 years from which application of the patent was filed in the United States. This is one of the examples. Uh, uh, Product life cycle. I will tell you that one BCG matrix is there. That is a Boston Consulting Group matrix. Uh, what are they? Matlab कि how this product life cycle is related or different from that. Actually, BCG is the similar analytical tool to determine the market positions of the product. In the four square tables, you can say, identify the base of their market growth in the market star. Stars are great, are the product with high market growth and a high market share, and cash cows are the products, you can say, low market growth, high market share. Uh, Question marks, also known as the problem children, are products with which market growth uh, and you can say low market price is. Uh, Introduction and maturity, if I'll say that is for this both, that a special consideration is there that companies that have good to handle all the four stages increase the profitability and maximize their returns, and those that are not able to may experience an increase in their marketing and production cost, ultimately leading to the, you can say, self-line product. Let me give you the one example that in 1965, that Theodore Levitt, a marketer professor, was there who has written in a business review that innovator is the one of the most, you can say, to close, you can say, the most to lose because so many truly products failed in the first phase of their life cycle, that in the introductory stage, and that failures only comes after the investment of subsequent money and time of research to cite it and establish, you can say, still thriving industry. Television program distribution has a related product in all stages of the product life cycle, and OLED TV is the, you can say, in the mature phase. Programming and on demand is in the growth stage, and DVDs are in decline, and the video cassette is extinct, and many of the most successful product on earth are suspended. Let me give you some examples, because until unless if you'll not support your answer with examples, then it looks very vague. Examples should be there. Let me give you the one case study of that Olds Mobile. Olds Mobile has it's not a mobile, it's a car company. Oldsmobile began producing cars in 1897 after merging with General Motors in 1908. The company used the first V8 engine in the 1916. By 1935, the 1 millionth Oldsmobile has been built. In 1984, Oldsmobile sale peaked and selling more cars in the year then by another year. By 4000, by 2000, that this General Motor announced its phase out of the automobiles. Well, next example is of Coca-Cola. If I'll say in 1985, this Coca-Cola has announced this new formula for its popular beverage referred as New Coke. Coca-Cola market share lead has been decreasing before 1985, and the company decided to launch a new recipe in hopes of that reverberating period of arrest, you can say. And after it launched, that Coca-Cola phone line begins receiving 1,500 calls per day, many of which companion about to change. The protest group recruits, you can say, uh, 1 lakh you individuals to support their cause for bringing old Coke back. A study of 79 days after its launch, that new Coke's full product life cycle was complete. Through the product, if you'll find that the product did not experience that much uh, growth or maturity. What are the stages of this product life cycle we have gone through? The what are the product life cycle strategies we have gone through? The what is the product life cycle management we have to? Why the product is important that we have completed? The factors put impact is there. If in few line, if will speak about that almost every product should undergo the product life cycle. That product life cycle, market introduction, growth, maturity, and decline uh, is there. Now, our next topic I have picked up. No, not this one. Oh, this one. This has came. This one. No, not this one. Oh, this one. Next is I have taken cost of capital. Uh, I don't know how that has come. Next, I think sorry, some other PPT has come up. Uh, Next topic I have taken the cost of capital. I will this cost of capital is uh, is the company's calculation of the minimum return that would necessitate in order to justify undertaking the capital busting project, such as you can say building a new factory. And that term cost of capital is used by the analyst and investors, but it is usually you can always an evaluation of whether the project is the projected decision can be justified by its cost. Investor may also use the terms to refer to an evaluation and investment potential returns in relation to the to its you can say cost and its risk. And many companies use combination of debt and equity to finance business expansion. For such companies, overall cost of capital derived from WACC, that is a weighted average cost of capital. Uh, Understanding the cost of capital, this concept of this cost of capital is the key information used to determine the project handle rate. You can say the company embarking the you can say on the major project, how much money project money means will be generated in order to offset cost of undertaking it, and then it continue to generate profit of the company. This cost of capital from this perspective of investor, it is an assessment of the return that can be expected from this acquisition of stock shares, you can say, uh, any other investment, and this is the estimate might include best or worst case scenario. That and what will happen that is, an investor might look that volatility. What volatility is there? What volatility is the same as beta of the company, and what is what investor must look at beta of the company's financial result to determine whether the cost your stocks cost is justified, you can say, by the potential return. Weighted average cost of capital, that a firm cost of capital is typically calculated using weighted capital cost of capital formula that considers the cost of both debt and equity capital. Uh,
Each of the firm's capital is weighted proportionally, you can say, to arrive at a blended rate. The formula considers every type of debt and you can say equity on the company's balance sheet, including common and preferred stocks, bonds, and other forms of debt. How to find out the cost of debt? That the cost of capital becomes the factor deciding which financing factor to follow: the debt, equity, and or you can say combination of two. Early stage companies rarely have sizable, you can say, assets to place as collateral loans. So equity financing become uh, the default mode, you can say, funding. Less than established companies, you will find less established company means limited operating histories will pay higher cost of capital than older companies, with you can say sold solid track record, since lenders and investors demand uh, at higher risk, and the cost of debt is merely that interest rate paid of the company on its debt. However, since the interest expense is taxable, the debt is calculated on the after tax basis. That is cost of debt equal to interest expenses divided by your total, where the interest expense is interest paid on the firm's current debt, and that company has marginal tax of rate, cost of debt, the total debt, interest expense, uh, that is one into one minus t into interest rate. That is where interest, that is int, interest rate equal to int, that is paid of the cost of debt is can also estimate by addition of a credit spread to the risk free, or applying, you can say, different risk free rate. Finding cost of equity. These all you have to calculate what actually it was there in the PPT. I don't know how it has changed. So the here this cost of equity is more complicated, since the rate of return demanded by equity investors is not as clearly defined, if I'll say, as it is by the lender. The cost of equity approximately, you can see, uh, the CAPM method. That's your CAPM is the same as cost of equity. Cost of equity equal to risk factor plus beta, risk of market rate of return, minus risk free rate of return. That is RF plus beta multiplied by RM minus RF. Beta is used in the CAPM formula to estimate risk, and the formula would require a public company was stock beta. For private companies, a beta is estimated based on the average beta among the group of the similar public companies. And this analyst, you can say, may define the beta by calculating it on the after base taxes. The firm overall cost of capital is based on the weighted, you can say, average of this cost. Let me give one practical example, that consider that an enterprises of the capital structure consisting of 30% and 30% of debt. when we will calculate that it will be like this, that zero point 0.7 into 10% plus zero point 0.3 into 7 plus it is equal to 9.1% into 0.7 into 10% plus 0.3 into 7% equal to 27, oh sorry, 9.1%. This is the cost of capital would be used to discount future cash flow from potential projects and other opportunities to estimate their net represented that is a net present value, that is NPV. And uh, what will happen, that companies strive to attain this optimal you can say financing mix based on the cost of capital. Various you'll find funding source are there. Debt financing is more you can say tax efficient than equity financing, since interest expense are detectable and dividends can be uh, covered, shares are paid, sorry, with after tax dollars. However, too much debt can result in dangerously, you can say, high leverage levels, forcing the company to pay higher level of interest rate to offset and the higher risk of what is different means how you are let us understand not the how, that let us understand what is discounted rate and how it differ from cost of capital. uh, they both are somewhat different, but the terms are often used interchangeably. That cost of capital is often calculated by company's finance department and used by the management to set a discount rate on a hurdle rate. You can say that must be beaten to justify an investment. Uh, that said, that company management should challenge it internally generated the cost of capital numbers, as they have they may be you can say conservative, as you will find to deter the investment. And the cost of capital may also differ based on the type of project or initiative. A high motivated you can say innovated but risky initiative should carry a high cost of capital than a project to update you can say uh, carry the project, okay, and it's a software with proven performance. Important of the cost of capital, that business you can say uh, if the return on the investment is greater than the cost of capital, then the investment will end up being a benefit to the company, to the balance sheet. Conversely, an investment whose returns are equal to or lower than the cost of capital indicates uh, you can say since the company had with the high cost of capital can expect lower proceeds in the long run, and investors are likely to see less that of you can say company equity. Uh, Let me give you some real world example, that every industry has own privilege average cost of capital, that the number are widely home building are you can say has reviewed um, the cost of capital at 6.35% according to this completion from one company. And this retail grocery business is relatively low at 1.98%. The cost of capital is among both the biotech and this pharma drug company, steel manufacturing, internet software companies, and integrated oil
gas companies. These industries tend to acquire, you can say, among the industries with the lower cost capital or money, central bank, power companies, real estates, investment trust, REITs, or you can say, and utilities, both general and water. Why cost of capital? That most of the business drive grow and expand. There may be, you can say, options, expand factory, buy out a rival, build a new bigger country, bigger factory, you can say. And before the company decides and any other options, it is determines that you can say cost of capital for this purpose. And what is the difference between not difference, how to calculate cost of capital. To calculate the WACC, you must first calculate the cost of debt and cost of equity. Uh, Cost of debt is that the cost of debt refers to interest rate paid on any debt such as mortgage and bonds. Uh, Interest expenses, you can say, is the interest paid to the current debt. The formula is that cost of debt equal to total debt divided by interest expense into 1 minus marginal tax rate. And cost of equity refers to return of a company's required to determine the business capital requirement are met in an investment. And this cost of equity are also represents the amount of market demands in exchange for owing, you can say, the assets. And therefore the cost of equity is approx, you can say, we can call it a CAPM, and the formula is risk-free rate of return plus beta, into risk market rate of return minus risk-free rate of return. WAC, the cost of capital is based on this based on, you can say, weighted average and cost of debt and cost of equity. That is WAC equal to E divided by V into RE. That is, E is market value of firm's equity, V is the sum of E and D, and RE is the cost of equity, plus D divided by V. That is, D is the market value of the firm's debt, V is, sorry, the sum of E and D, and R and D is the cost of debt into 1 minus TC, that is the income tax return. Here, this one problem I had planned to do it in this session, but in PPT, I don't know why it is not coming. Let me read out the problem that newly formed gold company needs to raise 1.5 million rupees capital to buy an office and necessary equipment to run the business. The company first raises $8 lakhs, you can say, by selling stocks, and shareholders demands a 5% return on their investment. So the cost of equity is 5%. Gold company then sells 700 bonds for rupees 1,000 each, and to raise the remaining dollars 7 lakh in capital. The individual who purchased the bonds expected a 10% returns, so that gold company cost of debt is 10%. This gold company's total market value is dollar 1.5 million, and Its corporate tax is 25%. The weighted average rate is called means the weighted WACC will be means calculated as what how so what will be the value that is WACC equal to that 8 lakh 8 lakhs that equity cup on what is the this 1 lakh 50 to 1.5 jo already it is given into zero point 0.5 then 7 lakh divided by 1.5 into 10 and it into the word tax that 1 minus 0.25 if you calculate this you will find 0.061 that is gold company is weighted average of a cost of capital will be 6.1%. I will share this PPT after making certain corrections. You will find this question over there, and the questions, a few questions are there of cost of capital. If we'll take out the answer because mostly I have found that these two are the important topic over there, and few more topics are there which I will cover in the next class. Any questions? Any questions? Shall we wind up? Shall we wind up? Okay. Now let us close. Thank you. Hello, madam. Are you there? Hello, hello, madam. Madam, are you there? Madam, hello, 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 madam, sir, hello, 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 Sapan sir.